Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at another viewer request company. This is a company that has been giving dividends for the past 65 years. Hedge funds have increased their position last quarter, and the 5-year return of this company is 121%, which outperformed the S&P 500. So if you like this video, do me a favor, share it with somebody, hit that like button, and if you're not yet a subscriber, hopefully by the end of this video you like what you see and you would subscribe. It really does mean a lot to me. As always, please remember that this is not financial advice. I'm not a financial advisor. This is just me sharing. With all that aside, let's take a look at this company. So the company I'm talking about is Genuine Parts Company. The ticker symbol is GPC. This is a company that distributes automotive replacement parts as well as industrial parts. So you can see founded in 1928. Global service organization engaged in the distribution of automotive and industrial replacement parts. So just a quick snapshot of this company. It is consisting of two. You can see the automotive parts group and then the industrial one. So maybe some of you guys know you have this in the stores, the Napa one. I know there's some in Hawaii, there's some stores that are Napa, so I'm fairly familiar with this parts company. So if we go to their annual report, you can see 66% of it is the Napa, and then what they do is they just do like heavy duty parts, automotive replacement parts, tools and equipment, automotive accessories. So you can see some of the locations in the United States, Canada, Mexico. And then the other part of this whole company is the industrial part, which composed of 34%. And then there's the Me Motion. So, and then these are the products, the hydraulics and industrial hose and all that. Now, if we go to the Snap financial results, you can see comparison between last year and this year. You can see Q3. This is the sales. And then Q3 of this year, you can see the sales. As you can see from the graphs, pretty much profits and all that has been great for them. If we go to the balance sheet, you can see total assets about 16, total liabilities about 12, total debt to adjusted EBITDA is 1.7x. Then you got your other things over here. Now if we swing to Simply Safe Dividend, based on their dividend safety score, they're rated as safe, which is 72. For this company, the dividend yield is 2.10, and you can see this is a large cap. And then you can see the beta is low. At the time of this video, it's 170. Looking at the key metrics, payout ratio is about 43. Forward payout ratio is 42. During the recession, they've increased their dividends in the 07-09. You can see right here, dividend streak of 65 years without a reduction, so pretty amazing. The dividend growth last 20 years, 5 years, which is just an average, and then the last 5 years is 4%, which is slow. The latest is about 9%, almost close to 10. Look at that. I just like always seeing an upward trend every year for dividend growth. You can see 65 years without a reduction now, and then consecutively 65 years increases, so which is pretty amazing. You're wondering about the payment details. You get paid quarterly in the months of January, April, July, and October. Annual payout would be $3.58 per share, which breaks down to about 89 cents per quarter. Yeah. Looking at the dividend yield is below the 5-year average. Price range is a little bit high in my opinion. It's closer to the 52-week high. So it's a really, actually it is a 52-week high. For me, I would love to maybe get it a little bit lower, you know. And you can see some of the stats in here: sales growth, earnings per share, and then the total sales and shares outstanding. Return on investment capital, you can see last 12 months 22. Return on equity 35% in the last 12 months. Now if we go to CNN Business, you can see the forecast for the next 12 months is in the high of 130, 173, 160 is the medium, and 124 is the low. And then their recommended analysis is about hold 12 analysis. Some buy, 2 buy, 1 underperform. Now if we swing to Webull, based on 14 analysis, they rated as a hold. You can see from here only a 7% strong buy, majority of them says is a hold. Price target getting closer to their target price of 173. 170 is the time of this video, and then you got 157, 124. Now if we go to tip rank, their rating is moderate buy. You got 1 buy and 2 holds, and then their price target is 163 with a 4% downside. You can see the high price target is 173, average is 163, and then 156. Now if we go a little bit more to the analysis, you can see outperform based on their smart score, and then you can see right here hedge funds have increased their holdings. So you can see confidence signal is neutral, but they've increased their holdings in the last quarter. Now if we swing to bar chart, based on their analysis, they rated at a high of 170, 156 is the mean, and 150 is the target. And then their average is pretty much similar to the others of a hold. Pretty much the past 3 months is the same. And then you got your current 6 hold and 1 strong buy. Now swinging over to Simply Wall Street, based on their company overview, you can see right here trading below 6%. Earnings are forecast to grow 6% per year. Earnings grew about 45% over the past year, and it pays a reliable dividend, and the risk is a high level of debt. Now if we go over here, you can see based on their estimate using their discount cash flow model, they rated as undervalued, only 6% undervalued. Their fair value is 182, and then you can see currently is about 170. Now if we swing to Stock Rover, based on their analysis, they rated also as a hold. 7 analysis, 1 strong buy, and then 6 hold. Now if we go to the comparison risk and return, you can see S&P 500, the industry, and GPC. 5-year return rated as 121, and then the S&P 500 is about 61. Even the 3-year return still beats the S&P 500, 78 versus the 32. And then if we swing to Y chart, one of the things I wanted to look at is the annual total return versus the peers. As you can see, here are some of the peers, and then here is the breakdown from year to year versus the S&P 500, and as well as some of the peers. So you can see right here, 2021 43%, S&P 500 is 28, and then you got your other ones. Now Yahoo Finance, you can see the top institutional holdings. You got Vanguard, BlackRock, State Street Corporations, Wells Fargo, and then you got Morgan Stanley, and Bank of America. So that's about it, guys. What I think about this company, I think it's a very solid company. 65 years of consecutive dividends. I think it's just amazing. I think if you're looking for a company to invest on, this might be one of them. The only thing I don't like is right now it is in the high price range. I would love to see maybe buying it in the lower one, but you know, it is a solid company. So either way, I think if I was going to buy this company, if I was going to start investing on it, I would usually just try to buy it on a dip. Just buy it dollar cost average, because it is pretty much in a high premium right now of 170. So thank you so much for watching, guys. Hope you like this video. Do me a favor and check out the other videos as well. As always, please stay cool out there, keep investing, and I'll catch you guys on the next video, right? Take care. Aloha. Bye.